Howdy, everybody. Welcome to the weekly wrap-up for Friday, July 15th, 2022. Hope everybody's having a fantastic week out there. Finally heading into the weekend, which is a good thing. The market had a mostly green today. I guess, people taking a step back and looking at the bigger picture. And there's probably a lot of people buying the dip. I think that might be a little bit dangerous right now. But hey, I'm just one guy. You don't have to listen to me if you don't want to. So we'll look at the longer term trends in a little bit and see what's going on the longer trend. The dollar's been really strong the last basically year and a half. Almost 2 years at this point. It's gone from a rating of around 90 to up around 107, 108. It's at 107 right now. So. All right, but let's go ahead and jump in and take a peek at how things are going this week or today. The Dow Jones finished up 2.15% at 31,288. S&P 500 up 1.92, closed at 3863. NASDAQ up 1.79%. Closed at 11,452. Small caps are up almost 2%. The VIX was down another 8.22% today. It's currently sitting at 2423. The other exchanges here in the Americas, Canada was up 0.36, Brazil up 0.45, Mexico up 0.75. Moving across the pond, Germany up 2.76, the UK up 1.69. France up 2.04, the Euro stocks up 2.37, Netherlands up 1.85, Spain up 1.81, Italy up 1.84, Switzerland up 1.69, Portugal up 2.83. Let's move on a little further east. The MOEX in Russia was up 2.24, the RTSI up 4.27. Moving on to the Asian markets, Japan was up 0.54, Australia down 0.68, New Zealand down 0.86. Headed to China, the Shanghai was down 1.64, the SESE component down 1.52, the China A50 down 1.5, DJ Shanghai down 1.66, and the Hang Seng down 2.19, and the Taiwan weighted came in up 0.78%. So looking across the day, looks like the Asian markets, took it the worst. It may have been just some contagion from the previous couple business days, but across, almost all of Europe, I mean, it's just a wall of green. Other than the VIX being down, everything else was up, 1 to 2%. So, again, it might be just some profit taking. I don't think I'd get too excited about it, based upon the bigger picture that's going on right now. But hey, like I said, I am not perfect. All right, well, let's take a look and see how the indexes fared this week. The Dow Jones looks like it's basically going to break even at down 0.19%. The S&P 500 looks like it's going to finish off down 0.45, so basically 0.5%. The NASDAQ looks like it's going to finish down 0.28. Dow Utilities. Let's see here. Looks like it's, again, fairly flat for the week, but up 0.37. And the Dow Transports look like they're going to finish down for the week, down 1.3. So that's probably the worst of it all. Everything else was fairly flat. Again, let's take a step back. We'll look at the Dow Jones. We'll look at the daily chart, scroll out here. We can see again, I know I probably said this a million times, January 4th was, looks like the peak for the Dow. And while my dog scratches, ignore the jingling of his collar. So right now the Dow is down from its high, is down just under 15%. And again, if we look at the trend, this downward trend line that we keep bouncing off of, we bounced off it in mid-February, went through it for a little bit in late March through late April. We were above this, and then it just fell back in line with the longer term trend. broke through again on May 27th, and then fell back below it again on June 9th. And again, we've just kind of been floundering out here in this space over here. So again, for the foreseeable future, I foresee that we'll probably, actually, let me drag it this way. Unless we break through this line of resistance and, continue the trend either sideways or up, I wouldn't expect this to really change for quite a while, especially with, recession talks, GDP being negative for the last 2 quarters, assuming that the numbers are right, when the Fed puts those out later this month. So again, we will see. But again, it really looks like we're in this for the long haul. So make your portfolio adjustments accordingly based upon that. If you need some help with that, I know a guy. Me. It's what I do for a living. And I spent the entire day going through research reports and doing quarterly rebalances. So fun times. I just love reading through tons of numbers and flipping back and forth between screens. So all right, let's jump back over and take a look at the economic data that came out this week. Had a bunch of news. Most of it was not great. All right, so first up, U.S. initial jobless claims came in at 244,000. The forecast was 235, so a bit over the forecast. Last week's number was 235, and had been in the 230s going back to the 16th of June, so a slight increase. Again, I wouldn't freak out about it. It's not certainly not the end of the world, and it's not the million plus that we had back two springs ago, where it peaked out at 6.8 million people filing for unemployment all in 1 week. It's a big number. And again, you can look back historically. We've never had a situation like that, at least since this chart has been reporting this information. So, the highest back in 2009 when things were so bad was like 600,000. So 646, 612. So anyways, all right. Continuing jobless claims came in at 1.331 million. The forecast was 1.383 million. So it came in under forecast. So that is some good news. Last week's number was 1.372 million. So again, we've been kind of holding this long-term trend for a while in the 1.3 and change. It's been that way going back to the last week of April. So again, I would say that is for now it's a win. Like I've been explaining to clients, jobs are typically a lagging indicator. Companies will probably start to feel the pain first before they start actually laying off a lot of their workforce. So next up, U.S. Consumer Price Index came out on Wednesday, came in at a much higher number than expected, came in at 9.1% year-over-year growth, and the forecast was only 8.8. So a bit of a miss there. Again, this does continue to climb, so we will see where this goes. And if you were to total up all the months worth of increases over the last, let's see, when did inflation really start to pick up again? I guess that was probably springtime last year. I think I've totaled it up a couple times. It's like between 12 and 14%. Gross inflation, since the whole pandemic BS 2 years ago. The producer price index, which is what the people you buy stuff from, as far as their goods and services, this is what they're paying. They're up 11.3%. Forecast was 10.7, so off by more than 0.5% there. Last month's number was a 10.9. And again, we did pull back from the April number a little bit. Did pull back for the 2 previous months that you can see there on the chart. But this is, the first step back up in a 2-month period. So again, until, for me, the way I look at it is until energy prices really subside across the board, we're really not going to see a lot of relief everywhere else, because energy just touches every aspect of our lives. It's basically the oxygen for the world. So retail sales year over year came in at 8.42%. Last month's number was 8.18. So again, looking at the chart, we did step back in April, and then we've been kind of sideways for the last 2 months. So again, we'll see, if things do continue to slow down and, the recession rumors really do take hold. U.S. industrial production year over year came in at 4.16. Last month's number was a 4.81. So again, you can see industrial production has been waning the last couple of months. And, I think, if we do head towards into a full-blown recession where companies are slashing and burning, we'll probably see this trend down a little bit more. The consumer sentiment index came in at a 51.1. Last month's number was 50. So we did bump back up a little bit. Forecast was actually for a 49.9. So the prognosticators thought it was actually going to be a little worse than last month. But we, did come in at a better number than what we were expecting. But again, if you look back over the last year, it's just been a steady fall. Really, we did pick back up after, what happened in March and April 2 years ago. We got back up into the 80s or the high 80s. But since then, we've been just in this steady slide. So, all right. I haven't talked about this in a couple of weeks, and I know I've talked about it with a number of clients over the last couple of weeks, so I figured I'd throw this in. The Baker Hughes rig count, we're currently sitting at 599. We were at 597 last week. And, we've been in the high 500s really for the last, 2 months, it seems like. So, there's a lot of factors to why the oil companies have, been slow walking, getting more rigs back up and operational. A lot of people point blame at the government and the administration and their lack of enthusiasm for the oil and gas industry. I know they want to have windmills and solar panels for everything. Frankly, it's just not practical at this point. I'm all for renewables and doing things as cheaply as possible with as least harm to the environment. But, you can't just turn off everything and expect it. Millions of people will starve, or actually probably billions of people will starve if we were just to stop using oil and gas altogether. All right, well, let's go ahead and dive into today's market recap. S&P 500 in rally mode as strong economic data eases recession fears and banks rally. The S&P 500 jumped Friday as better than expected economic data eased worries about the pace of slowing economic growth, while Citi rallied following impressive quarterly results to help financials claw back losses from a day earlier. Financials led the broader market higher, boosted by rallying bank stocks after Citigroup reported better than expected quarterly results, sending its shares more than 10% higher. The Wall Street Bank was helped by blowout performance in its trading business that offset weakness in its investing banking revenue and an announcement that stock buybacks would be suspended. Wells Fargo, meanwhile, surged 6% despite reporting quarterly results that fell short on both the top and bottom lines as the bank set aside more money to cover potential losses from bad loans. Bank stocks were also helped by steepening in yield curves as data showed the consumer remains in good shape, ease some concerns the economy was headed for a significant slowdown. Retail sales rose 1% in June, the strongest pace in 3 months, and above expectations of 0.8%. Following the report, economists at Jefferies pointed to the fall in gas prices, signaled optimism for a further boost in the consumer spending that could set up the economy for, quote, for much stronger GDP growth in Q3, end quote. Excuse me. United Health Group Incorporated, a major Dow component, rose more than 2% after delivering strong guidance as quarterly results topped estimates, driven by stronger performance in its Optum Healthcare Services business. Technology continued to its uptrend, led by gains at Amazon Meta Platforms, with the latter up more than 4%. Amazon was in the spotlight after it said 300 million items were sold during its annual Prime Day sales event. Quote, Prime Day results make us incrementally more confident in the strength of the consumer, their willingness to spend post pull forward in COVID demand, and as a result, Amazon's forward top-line growth, Morgan Stanley said. Twitter Inc. gained more than 2% as its case against Musk for terminating its $44 billion deal to take over the company, alleged without cause, is expected to get underway on July 19th. I don't think it's going to work out well for Twitter, quite honestly. I think Elon's probably got them over a barrel, and they're going to have to disclose how many fake accounts they got in their system, and it's not going to look good. So, discovery is going to be a bitch for them. Quote, there are a range of possibilities that can come from the Delaware court, including settlement, breakup, fee paid, deal enforced, and a myriad of other outcomes, Wedbush said in a note. Pinterest rallied more than 14% on reports activist investment firm Elliott Management reportedly took a 9% stake in the struggling social media company, which has been, seen its shares slump about 50% year to date. All right. So I guess everyone going into the weekend's feeling really good. I don't know if I express the same sentiment long term, but hey, people, they can have their little victories. This next article has to do with oil. Another week in the red, despite no extra barrels from Biden's Saudi visit. So, based on some of the snippets I've gotten, he didn't get anything that he was hoping to get from the OPEC nations. And as far as I understand it, they are pumping at full capacity. So I'm not sure where he's expecting them to find more oil. All right. Oil ended another week in the red as heavy losses induced by a strong dollar prevailed over optimism that President Joe Biden's Saudi Arabia visit will not result in immediate additional barrels on the market. Crude prices also recovered from the week's lows after assurances by key Federal Reserve officials that the central bank might not be ready yet to impose a record 100 basis point rate hike for July, despite inflation stubbornly remaining at 4-decade highs. Raphael Bostic and James Bullard, Fed chiefs for Atlanta and St. Louis, respectively, suggested that a 75 basis point hike was the preferred increase for July. Yeah, just got to keep nibbling, instead of actually just karate chopping that thing, you got to just nibble away. And, I don't know. I think they're making a mistake, but, what do I know? New York traded WTI. Crude settled up $1.81 or 1.9% at $97.59 a barrel. For the week, however, WTI was down 6.9% after plumbing near a near 5-month low of $90.58 on Thursday. The U.S. crude benchmark has also lost 8.1% since the start of July. London traded Brent settled up $2.19 or 2.2% at 101.16 a barrel. The global crude benchmark fell to 95.42 in the previous session, marking a low since late February. For the week, Brent was down 5.5%, while for July, it has lost 7.4%. Brent has fallen for 5 straight weeks now, losing a cumulative 17%. WTI has been in the negative for 4 of those 5 weeks, sliding a net 19%. Quote, oil prices are edging higher again after falling around 20% over the last month in response to increasing recession fears, noted Craig Earlham, analyst at online trading platform Owanda. Quote, the soothing words of Bullard and Waller reassured everyone that 75 basis points remain the best case, end quote, for rate hikes, Earlham added. Quote, Brent has moved back above $100 a barrel on those comforting words, but promises to remain choppy amid a tight market and ongoing recession concerns, end quote. Reuters, meanwhile, cited a U.S. official as saying that immediate boost in Saudi oil output was not expected despite Biden's visit to the Arab nation to meet with Riyadh's Crown Prince Mohammed bin Salman and other OPEC officials there. The U.S. official said at the best, Washington could hope for higher OPEC production from August onward. Even before Biden's trip, there had been questions as to how much more OPEC would be able to put out, given the incessant media narrative that the cartel had production constraints due to underinvestment in the oil fields of its member countries during the market crash of 2020 brought on by COVID-19. Oil bears, however, dispute OPEC's account, as the cartel always seems nimble in overproducing during past market crises. Quote, part of the support today is that everybody and their brother who digs down in the Saudi situation see that they don't have a lot of capacity left. John Kilduff, partner at New York energy hedge fund Again Capital, was quoted saying, looking to the week ahead, analysts said U.S. crude prices were at an inflection point of either breaking out to 106 and beyond or falling back to set new multi-month low of $83. So time will tell. We will see. And what is really putting a lot of downward pressure on oil prices? The dollar. So the dollar's been really strong, and I know I've talked about this a lot. That the dollar has really increased in strength over the last 2 years and has really put a damper on most commodities across the board. Gold, silver, oil, and those are the things that typically in an inflationary environment are a nice backstop in a portfolio. And for those things to be sideways is a little strange. So, my personal belief is that the dollar's run is going to run out. And actually, the next article after this, we'll talk about that. But we'll see. Dollar dips on profit taking. Fed rate path in focus. The dollar fell on Friday as investors evaluated how high the Federal Reserve is likely to raise interest rates by when it meets later this month, and as investors took profits after a strong rally that sent the greenback to a 2-decade high on Thursday. The greenback has jumped as the Fed is expected to raise rates faster and further than peer central banks as inflation soars to 4-decade highs. The dollar briefly gained on Friday after data showed the U.S. retail sales increased more than expected in June. Quote, "It's a little bit better than expected, but I think everyone realizes that probably that is due to inflation," said Joseph Travesiano, senior analyst at FXStreet.com in New York. He added that investors are closing positions before the weekend and after a long, strong run in the dollar, end quote. Other data showed that manufacturing production slumped for a second straight month in June, and U.S. consumers tempered their inflation expectations in July. The dollar fell to 108.04, down 0.47% on the day. It reached 109.29 on Thursday, the highest since September of 2002. The euro gained 0.57 to $1 and 0.0080. It traded as low as 0.9952 on Thursday, the weakest since December of 2002. Traders ramped up bets that the Fed will hike rates even faster after data on Wednesday showed U.S. annual consumer prices jumped 9.1% in June, the largest increase in more than 4 decades. Odds of a 100 basis points move fell, however, after the two of the most hawkish Fed officials on Thursday said they would prefer a 75 basis point hike. We talked about them in the previous article. Atlanta Fed President Raphael Bostic on Friday also cautioned against the central bank moving, quote, too dramatically because it could undermine the strong hiring and other positive trends still seen in the economy. Fed fund futures now indicate an 81% chance of a 75 basis point increase and a 19% chance of a 100 basis point increase. The euro faces two major potential catalysts next week, with the European Central Bank expected to hike rates by 0.25% for the first time since 2011 when it meets on July 21st. Investors will also be focused on whether the critical Nord Stream 1 gas pipeline to Germany from Russia will reopen. After closing for maintenance this week, it is planned to reopen on July 21st. But European governments are worried that Moscow could extend that in order to restrict European gas supply, disrupting plans to build up storage for winter. Why would Russia do that? Oh, wait, you've been boycotting them all year. That might be why they would do something dastardly like that. The dollar slipped 0.27% against the Japanese yen after hitting a 24-year high on Thursday as the Japanese central bank maintained a dovish stance that contrasts with hawkish moves by other central banks. The Australian dollar gained 0.6% after dropping to a 2-year low on Thursday on concerns about global growth. All right. And the last article here has to do with, is this the beginning of the end for the dollar's irrepressible rally? Flows and long-run Fed expectations anticipate the dollar is entering the final stages of its bull run. Long positions will begin to struggle, while currencies better placed to soon start outperforming will look more attractive, such as the euro or the, what's the SEK? Let's look that up before we go any further. Search the web. The Swedish krona. The dollar, as measured by the DXY, has rallied about 20% over the last year, breaking all sorts of things on its way. It breached parity with the euro for the first time in 20 years and took the yen to its weakest level in almost a quarter of a century. But the market is beginning to see the limits of the Fed hiking cycle, despite the prospect of a 100 basis point hike at the July FOMC. Deeper cuts starting in 2023 are also being priced in, as the expectation is that the Fed will create a recession that will be met with easier policy. The result is that long-run Fed rate expectations are beginning to fall, even with aggressive hike bets for meetings to the end of the year. Long-run Fed expectations have given an excellent lead on the dollar, but they are now topping. The dollar may soon run out of steam. We are seeing the same message from the yield curve, which is showing the first signs of flattening for over a year. The The institution here is that the real yield curve is a proxy for the inflation-adjusted carry foreign investors in the U.S. earn when buying U.S. debt, borrowing dollars at the short end of the curve, and using the proceeds to buy U.S. treasuries or corporate debt. Indeed, the Treasury International data in the U.S. for foreign transactions for government and corporate bonds leads the dollar by about a year. Foreign demand for U.S. fixed income is waning, suggesting demand for dollars will follow suit soon. Fixed income inflows tend to be hedged, but the hedge ratio does not always need to be 100%. Moreover, it's even less likely to be so when the dollar is in a strong upward trend, making the prospect of extra uplift for foreign investors perhaps too tantalizing to forego. Ways to selectively short the dollar will begin to look more inviting. Example versus the euro as China stimulus slowly feeds through to Europe, or the krona, which has been the weakest G10 currency in recent months and would act as a higher beta version of the euro. So, based upon their analysis, they think that the dollar is going to run out of steam sooner than later. And let me actually bring up a dollar chart here for you to look at. We can see over the last 5 years that, back here in, where's the beginning? Here in 2020, we somewhat bottomed out around, I guess that was about December. We actually hit 89.894, and then slowly over, with all that dollar creation over the last 2 years, we've seen the strengthening of the dollar, just go through the roof. And what I would really need to look at is how much more inflation the other six currencies that the dollar is rated against. Based on my own looking at this, I would expect that they probably have inflated their currency and done more quantitative easing than we did, which is why the dollar actually looks better. In the big picture, the dollar isn't really stronger. It's just better than the others. So, it's like pointing out the tallest midget in the room when you're picking out a basketball or trying to choose teams to play basketball. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. You can see that my puppy's back here. My security detail has fallen asleep at my harmonious tones coming through the airwaves. So, but like I said, if you need anything from me, go to dsafinancialgroup.com. All my contact information is there. And, if you need to book a meeting, drop me a phone call or an email, feel free to do so. And I'll be back on Monday with the weekly economic update and any other news that's happened over the weekend. So y'all have a good weekend, and I'll talk to you then. Bye.